What's up, Colorado Springs? Chris Lopez here, and we have another Ask an Investor episode coming to you with a guest coming from out of this country to ask some questions and talk about how he's building a portfolio here in the United States. Before we get into him and introduce him, Jenny, how are you?
I'm doing great. How about yourself, Chris?
Doing really good. So, Ask Investor, a great idea you had a little bit back. So, give everyone just a quick update what the format of the show is and why we're doing it.
Yeah, so we just want to bring in someone for a full episode and just get the chance to talk to each other, kind of give, personal experience and answer their questions because we have found that most people tend to have the same questions as each other. So hopefully by answering, one investor's questions, we'll be able to answer many investors' questions. So
All right. And our guest today is Greg. Greg, how are you doing?
Good.
Yeah.
Good.
So give everyone a little bit of background because you're in a very unique situation. And there's other people that can relate to you, though.
Yeah, sure. So I'm in the military. I left Colorado Springs about 2.5 years ago and moved out to Germany. And I'm getting ready to come back to the Springs sometime this winter. So I'm really interested in house hacking and specifically a small multifamily property. So I'm new to investing too. So I got started. Sorry.
Oh, sorry. I was going to say, what's your existing portfolio look like? Because you were an accident landlord, now investor.
Mm-hmm. Yep. So that I bought a house when I was in the Springs the first time, fully intending to move back to it once I returned from Germany, but realized that this real estate investing thing is pretty sweet deal. So started learning more about it and really wanted to jump in, but it was hard overseas. So the next best thing for me, I figured, was turnkey. So since I've been in Germany, I bought 2 turnkey properties in Kansas City.
All right. So got your first house in the Springs, turned to a rental, 2 turnkey rentals in Kansas City, moving back here next few months to the Springs, and plan on house hacking a multifamily, right?
Yep, you got it.
All right. So as the show's titled, it's Ask the Investor, and I know you got lots of questions, Greg, that you shared with us previously. So jump in and fire away.
Okay, yeah. So the first one, I've been paying attention to the market in the Springs a little bit, and it seems like when small multis come on the market, they're gone immediately. So I would prefer to try to find one off the MLS, but if I can't, I'm considering trying to find one off market. So my question with that is, if I do find an off market property, is that something that an agent would be able to help with? And like, how would that work with an agent? Like, what would they do? Is that something they're even interested in? And then also, how would the fees work for that?
Yeah, I can take this one. So I agree. I'm seeing the same thing that you're seeing in terms of, if anything is a good fourplex, it's gone within a few days. And the only reason why it's on for a few days is because they're collecting as many offers as they can. So it is highly, highly competitive. I think a lot of that reason has to do with just kind of where rates are. People are figuring, hey, I can get a really good interest rate on 4 units that is an amazing way to leverage and utilize that. So I think that is contributing to people's intense interest in small multifamilies right now in the Springs, especially. So in terms of finding an off-market deal, so Leah, who is another agent down here in the Springs, she currently has an off-market fourplex under contract that we were able to source ourselves. I'm working with another group of buyers to hopefully get an off-market fourplex under contract also. So it's not unheard of. Like, we're definitely, we have our ears to the ground trying to, get information regarding these availabilities and opportunities. So in terms of that, there's really nothing different the way that those processes are working. We're still bringing those properties to our buyers, the ones that meets their profiles, and just saying, hey, what do you think about this? Do you want to move forward? That sort of thing. And just in terms of commission, typically we would just write in the contract that seller to pay buyer's commission because it's not in the MLS. And the MLS is kind of where you set your co-op fee on that. So that would really be the only difference on the commission side of things. In terms of procedures and bringing the deal to close, there's no difference. It's just a matter of sourcing. And then if you were to find a deal that's off market but you still wanted to work with an agent to bring it to close, basically it would just be the same process. So, I'm a little biased, but I think that if you are not used to buying things off market and you're not really used to the sales process and the closing process, I mean, I think that it's very helpful to bring an agent on board and help walk you through that process. Just coordinating with title, coordinating with the seller to get inspection, all that good stuff. Utilizing our resource network. So that's my opinion on that. I don't know, Chris, do you have anything to add on that?
Yeah, I agree with everything you said there, Jenny. I just know from a lot of the transactions we've done, especially for house hacking, I would not make it like the main focus to find an off-market property for a house hack, just because the two main things are in there is just, if you're going to truly source the deal yourself, Greg, it's just, it's you're basically starting a marketing business. Go out there and source a deal if you want to really scale up. Now, if you have opportunities to, hey, network, I'd always throw it out to people. Or if you want to, write some, very personalized letters, they all have I want to bank on using those methods to go out there and find an off-market property. But I think it's always worth throwing it out there as long as you can keep in a relation with, how much time you're putting out there and how much money. Because a lot of these, people who are sourcing these deals, they're on the phone 40 hours a week, or they are spending $10,000 a month on marketing, direct mail cost, or have a team of people. So, a lot of times against very competitive people who are finding those people, and they already have their systems in place. The other thing too is you mentioned, looking at like a FHA multifamily, or I'm sorry, multifamily property house hack. I'm assuming you'll use an FHA loan. Have you kind of thought about that yet?
Yeah, so I'm planning on using a VA.
Oh, that's right. Yeah, duh.
No,
VA. I was absolutely. So the VA loan, the most amazing loan product in the world. The problem with that is if, unless there's some control with or relation with that seller, if it's like a wholesaler or someone else who's selling the property, a lot of times they don't want to deal with an owner occupant financing, because VA loans are usually one of the longer loans to close because they have to go through the VA appraisal system. And there's just lenders can't speed that up. Like if it's an FHA, we can rush the appraisal, we can get things done quicker. But even with owner occupant loans, there's other just contingencies and things going on about it that can make it less attractive for a seller to say, well, I'm going to deal with you and your loan product where I can take a cash offer here for a quick close or less stipulations. So I think the financing side, especially for multifamilies, makes it a lot more difficult to find like an off-market property, in the traditional sense, like, hey, I'm going to drive for dollars. I'm going to cold call. I'm going to go out there and do the deals or, find the deals. But if they come in through our network, your network, that gives you a much higher chance. But truly like driving for dollars gives you a very low probability. And I don't think the money and time effort is worth that, especially when you're going to be putting basically 0% down. Like, you're winning on the financing.
Yeah, and that makes sense. So I'd eventually like to get to off market, but I don't know. As a first one, it seems challenging, and especially using it to try to find a primary residence seems really challenging.
So I mean, I go for it. It's just been a very low probability of success with our clients. We've had a few people here just through networking, or they talked to the neighbor across the street, or writing a few letters. They found the deal. But again, I would not bank on that to like say, I want to buy a place exclusively through that. And a lot of times, like the deals aren't that much different than MLS deals, other than you're not butting up against 6 other people bidding, so it's less competitive, which is nice. But it's not going to be like a screaming deal that's going to have like a 3x factor in your wealth creation.
Yeah, sure. So that leads to more questions. So you said 6 other buyers. Like, who else is buying small multis in the Springs?
Everyone, it seems like. So I've seen a lot of people that want to just expand their portfolio and like I mentioned earlier, just take advantage of the cheap debt that's going on. There's a lot of 1031s that I've been seeing floating around, just, even reading in the MLS, like all the agent notes and stuff, pretty much everything touches on a 1031, one way or another on that. So, I think just it's a very attractive area. It's a very attractive product. And I believe that there are a lot of people that are, trying to purchase a multifamily. And I think one of the more difficult hurdles we will have to overcome is one that will be able to satisfy your residency requirement if you're using a VA loan, because kind of on the other end of the spectrum, rentals are very much in demand as well. So I would not be surprised if these owners have a line of potential tenants that want to rent if there's going to be a turnover, or tenants that don't want to turn over, because they like the property and everything. So just kind of keeping that in mind, that there's a whole gamut of investors that want to purchase for various reasons.
And other house hackers.
Yeah, for sure.
But it's a lot of
the
the 1031 people.
Mm-hmm.
So yeah, because I would like to use the VA. I don't have to. I think you could probably use other options. But you partly answered it. Is VA comes with a whole bunch of other stipulations, like you have to intend to move in within 60 days. What else? The appraisal, just all that. Really, just working through the government, so it goes slower. Mm-hmm. How much would that hurt me, do you think, with sellers trying to use a VA versus, say, a conventional mortgage?
I think it all depends on what the other competition is, and how that goes into their timeline. If they are 1031ing, that could impact things. Like, they'd want the deal to fall apart on the front end, not 45 days into it, that sort of thing, because then they could, keep on track for their own timeline. So I think it all depends on who's on the other end of that offer. That would be my answer.
It's not going to be a major hurdle. It's a different aspect of the buying process. I mean, for all the, the people who've helped out with VA loans and FHA loans buying small multis, we've always gotten a deal done. So it's not like, oh, you're not going to find anything. We will get the deal done, or you'll be able to find a property that works well for you. And sometimes too, I mean, we've had situations where we've had clients using a VA loan that pulls on the heartstrings of the seller, who might be a retired, military personnel, or just appreciates people in the military. We've had sellers literally tell us, hey, there are like 6 offers. You guys weren't the highest or best, but I want to help out. I'd rather help out a service member versus an investor, add another property's portfolio. We've actually gotten a couple properties that way. And so they can actually work the other side too. It's like, hey, you're just, you're a young guy serving the country, looking to get into real estate investing. Some people are like, you know what? Yeah, I want to help out that person versus, this investor from California, or this investor from Denver who's just 1031ing into there. So it actually can work in your in a pro for you as well. And I would, put that out there too, mentally. Like, I think writing love letters, I don't think they're really, I don't know if we don't do them anymore. I don't know if you do them, Jenny, but they're pretty.
No, they're very frowned upon. Yeah. It's like fair housing violation in some respects. So,
okay. Yeah. Can see that.
But yeah.
But they'll know if you're a VA loan, they know the situation,
Yeah.
Yeah. And I was going to ask that same exact, like, what do you think about writing a personal letter, but you just answered it.
Yeah.
I wouldn't.
Yeah. But most agents, they don't even, if you send it to them, they're like, hey, we're not going to open the email. We're not presenting to our seller, just for all the fair housing laws, because if that comes to play, and then, it can be a completely different series of events. But hey, if it looks like someone potentially discriminated, there's a lot of issues there for the sellers, the agents, and no one wants to deal with it.
Yeah, it'd be a whole can of worms that probably doesn't even need to be opened.
Yep.
Okay, so my next question's about rents versus the price of properties. Because I listened to your other podcast that came out a couple months ago, and that it sounded like that was more specifically for apartments. So it's really two parts. So prices have gone up a ton. How have you seen the prices for rents for both single family homes and small multifamilies? What have you seen those do? And then how are small multifamilies, the rental cost, like how do you figure that out? Is like right in between a single family home versus an apartment?
Yeah, so I like to analyze small multifamilies kind of more in line with apartments. And apartments that don't have, gyms and pools and all that good stuff, because I imagine that you will not be installing those in your multifamily. So when I'm analyzing rents, tends to be what I look at. To answer the very first question, rents have been going up really significantly, both small multis, single families, large apartments. There's constantly, I'm seeing new news articles kind of catching up to the fact that rents have jumped pretty astronomically over the past year. And, with personally speaking, with my turnovers that I've had, I've been able to command much higher rents than what I was previously getting. So it all kind of depends on I would also say the legacy of the multifamily that you're buying into. So for instance, most landlords, I would say, don't raise rents on good tenants. It's just, kind of part of the business. So if you buy a property that has three tenants that have been there for 10 years and they're amazing tenants, they keep the property up well, you're probably not going to see those rents in line with market rate. And then you're going to kind of be faced with that situation. Hey, am I buying it at a pro forma price? Am I buying it at actuals? Personally, I don't like raising rents on good tenants like that. So that would be a balancing act. However, we just worked with a buyer who bought a really nice multifamily, a fourplex, and two of the units were vacant. So it was basically like, two of the units he has at those legacy pricing, they're much lower than market value. He's going to keep it that way, but the empty units, he's going to raise them to market value. So I think that's just kind of, you have 3/4, when you move out, units that you kind of have a balancing act to figure out based on that. So I don't know if that really answers your question, but just is very variable is kind of the punchline to that.
So I've got, I don't know if you saw this from the Denver Post the other day, Jenny. I think it came out just on Monday over the weekend.
Yeah.
But they're running, the title is Rising Front Range Rents are Widespread and Will Keep Climbing. And they quote an economist from Apartment List in their written report. But here's what it says, Greg. Colorado Springs rents are up 22% since the start of the pandemic.
Yeah.
This is one of the biggest increases we've seen anywhere nationally.
Yeah.
And there's different things in the front range, but according to this and the stuff I've seen, I think Springs has been kind of like the leading edge of seeing rents bump up. So, rents are definitely climbing, astronomically this last, year to date or last year they have. And that kind of loops back to why there's so many buyers for multifamilies as well, because, there's a loss of guard. There's chatter that 1031s might, be changed, which, hey, that anytime it happens, that always gets investors moving. Debt is really cheap, especially for these like 2 to 4 unit multifamilies. Buy a property, put it on 30-year fixed around 3.5% or the high threes, or a little bit above inflation, or actually below inflation last couple months. And so it's a big hedge. So people see, hey, there's no housing. There's not enough housing inventory from building and rental standpoint. Debt is cheap. Rents are climbing. They're all seeing the same headlines we see for inflation, whether it's long-term or temporary. And so that's where a lot of people, hey, let me just leverage up, buy real estate, because real estate's, historically one of the best hedges against inflation. So a lot of people are just simply parking money to ride that wave of growth, or the wave of inflation growth, we want to call it. And Springs is just, it's kind of like in a perfect storm where you have all this economic stuff going on, but it's also just a very attractive market from just, what the Springs is doing locally.
Mm-hmm.
Mm-hmm.
Yeah.
So it sounds like it's right in line with what appreciation's been over the past year. We're pretty close to it.
Yeah, it's been about, I think, 20-ish%. So yeah, it's I've been shocked at the rental rates that, our clients have been getting, I've been getting. So it's I wouldn't make it a deterrent, even though I would say probably end of last year, I was saying that it is an issue that rents are not keeping up with appreciation, but I'm not really seeing that right now.
Okay. Yeah, because I was just getting snapshots like from the MLS, it reflects the higher prices, but I just don't think the higher rent yet. But it sounds like it's not an issue.
Yeah, that's a really great point. People are definitely selling and valuing off of pro forma rents, which, there's a lot of different schools of thought on that. I would say the summary is you're not going to win a property if you price it based off of current rents in today's market, with how competitive it is, because people are going to pay based off of pro forma.
Yeah. So, that's going right into my next question. So I'm curious to get your thoughts on like purchasing a property that is either neutral with cash flow or even negative. And then, so my line of thinking is something I'm thinking about is the expected appreciation and loan pay down, and then expected rising of rents, 2, 3, 4, 5 years in the future, offset the risk of potentially a negative cash flow.
So a lot of it just depends on, the investor's personal goals and also the financing. Like it's hard to look at like a multi-unit with a 0% down loan and say, oh, damn, it's not a great cash flowing property.
Mm-hmm.
So it's kind of like a double-edged sword there. It's a 0% down property, which is amazing for you, because it's, you'll be $10,000 or less out of pocket, for, $750,000 asset. But at the same time, it is gonna like, give you very little, no equity in the property, which just slim down the cash flow. So, there are people that, will absolutely not do it, and there are people that will do it. I think it just kind of comes down to what your risk tolerance is and your beliefs. Personally, I'm fine with that, especially in situations like you, because, hey, you're putting so little down. And even if you, otherwise, hey, you want to put down 25% of the property, we're talking $150,000, $200,000. Big difference. So I'd rather keep more cash on hand, have a neutral cash flow property, but be like, you know what? I see the economic indicators. We don't have enough supply. Rents are going up. This is happening. This is here. This is here. Like, yeah, it should probably go up. Worst case, it may flat for a little bit, but that's where it kind of comes down to what your risk tolerance is, how you view it, and how you also have your cash reserves, because you definitely want to keep healthy cash reserves so you can, keep it going. Or, another way I look at, hey, use a 0% down payment. You have basically your tenants subsidizing your down payment, because rather than having to put down 20 or 25%, you have your tenants do it, and you can delay all that cash out of your pocket by having tenants come in there. And that gives you a great, there's an opportunity cost to your capital in there. And then, there are people that just say, nope, no way will I do that. And then that works for them. And, I've talked to people, and you know what? They told me that 3 years ago, and they have still bought no properties. So there has to be a balance of like, hey, I want this. Like, hey, there's deals I want here when I buy stuff, but I'm also realistic to like, hey, here's what the Denver market, here's what the Colorado Springs market is doing. I can't really change it. So kind of like, being realistic with what's going on in the market is my 2 cents.
Yeah, that makes sense. It'd be easier to put down more in reserves if you're not even paying much of a down payment at all. So instead of the 25% down payment, just shrink that a little bit, but then that would just become your reserves.
And one more thing you could look at too, because with the VA, I mean, you'll probably be at what, high twos or low threes currently for, I would imagine, the multifamily using a VA. So, you're around inflation, and then you're still going to be below like the cap rate. So, one metric to look at is the spread between cap rates and interest rates. So, hey, you're buying a 4.5 or 5% cap rate, but you're borrowing at 3%. You have a 1.5 to 2% spread on there, which is a great indicator. Now, when interest rates go above cap rates, it's a different story. But if interest rates are below cap rates, from a pure financial perspective, it's a really good indicator to look at.
Okay. Yeah, never. So I know, like, I've heard cap rates, don't really understand them.
Wow.
But you're saying if like the normal mortgage rate is below a cap rate, that's a good indicator to buy. What does it indicate?
It's a good indicator that you're making a spread, a profit on the money you're borrowing and what the property is returning on you, without taking like all the other indicators of how you make money in real estate, but really from like, just a pure borrowing cost and how the property is performing. It's just a good indicator in that sense of, hey, your borrowing costs are cheaper than what the property is producing. Great.
Okay.
And I can send you some more detailed information on that as well, because it's a tricky concept.
Right. Yeah, and like to read up on it.
Yeah.
So then, kind of in line with that, like trying to figure out cash flow, what are you using to analyze properties, specifically small multis, and specifically some of the things that aren't, like, I guess, as readily available or easy to pick up on? It's like things like utilities, insurance, and then even with like prices being higher now, repairs and maintenance and vacancy.
Yeah, great question. So it definitely depends on what part of town you're in, because taxes will be different, insurance will be different depending on what part of town. And then, of course, utilities, that can vary widely depending on how the unit is metered. So most units are, and this is a very blanketed statement, of course, each property needs to be checked out and confirmed when we evaluate it. But, just generally speaking, most multifamilies are individually metered for electric and gas, and they are typically not individually metered for water and sewer. So for a fourplex, I use about $2,600 a year for water and sewer, because that's just been what my clients have uncovered in due diligence over the past few months for fourplexes that they're buying, and that seems to be the going rate. So I use that as a ballpark. Property management, I think 10% is probably good. A lot of multifamily PMs do about 8%, and then that 2% difference is lease up costs, miscellaneous management costs, things like that. For repairs and maintenance, I tend to do about 8%. And then for vacancy, about 5%. And, that can vary widely depending on, again, which area it's in, what the condition of the property is when you buy it, that sort of thing. But those are pretty good rules of thumb. And then landscaping and snow removal, I do about like 600. I try to look to see how many steps it looks like they have, because some have like stairways going up, and some are just very like ground unit, that sort of thing. And then other than that, I just kind of take a look at it on a case by case basis. Some fourplexes belong to an HOA, like a covenant enforcement. So sometimes that covers trash. So, it's important to kind of look into that. It's like, oh, well, it's in an HOA. That's unfortunate that I have this additional cost. But if it covers trash and it's $500 a year, well, that pretty much negates your trash expense. So it's just kind of going into each one like that. But trash would be another one that we've been seeing run up on trash prices, but $60, $80 a month for a large dumpster is a good guess.
Cool. And then are sellers generally forthcoming with providing that information, or is that on like the buyer to? I'm sure like through due diligence to do it, but like making predictions in lieu of not having any information on it.
So they're usually forthcoming and telling you what utilities are metered. But in terms of details on, whatever average is, typically no, that would be on us to make a best guess for the offer price point. And then when we're in due diligence, that's when we would do a deep dive on that. And they have to abide by that. We write that into the contract so that they provide us with those details.
Okay. And then do you have a rule of thumb or any better way to estimate insurance costs?
Ooh, yeah. So
best guess right now.
Yeah, it depends. So for fourplexes, I've seen some like 2,500 plus. So if you want to be on the conservative side, high 2,000s for the year.
Okay, I think that's pretty close. Most of them just throw in like 200 a month, and probably fairly close, I guess.
Yeah. I mean, at that point, like, what's a couple $100 if we're off at that point? So.
Yeah, and then insurance, it's not going to vary that much from property to property. It'll be a couple $100, maybe a few $100, depending how what insurance company you're talking with or how you structure some of the deductibles and those features. I mean, the biggest thing that I've seen, that can be the gotchas of the insurance is if it's in a flood zone, which I don't know in Colorado Springs, but very few properties in Denver in flood zones, but they back up to a gulch or something like that, to where we've had a few times, and then you have to get additional flood insurance. But that's definitely very much like the minority of cases. I mean 1%, if not less, of properties that we've seen. So it happens very rarely. So just using a rough ballpark is my recommendation. Again, who cares about $200 into the year? And then we always like to tell our clients is, property insurance is one of the due diligence parts of the contract. And if you're not happy with the insurance, that is a reason you can cancel the contract. So when you go under contract, get the property insurance quote ASAP from your insurance person. And then that way you have a real quote and can make, underwrite it and make adjustments as needed based on the underwriting. Or if it's in a flood zone or some crazy stuff, cancel the contract.
Mm-hmm. So on contingencies, what normally do you recommend for contingencies? Because what I'm thinking is like with the market being so hot, what is that balance between being protected versus not getting your offer accepted?
So for contingencies within the offer itself, you mean? Or
yes. Yeah.
Oh, okay. So it all depends. Yeah, it all depends. A lot of times earlier this summer, we had to do appraisal gaps to win the offer. Not so much now. I think we're a little bit more caught up. So, that's not as dependent. A lot of things or a lot of offers that I've written, the buyer wants to do an inspection limitation, meaning that, hey, we're not going to object to, this outlet is broken or something like that. We're going to draw a line in the sand and say we're only going to object to things that are $1,000 or more, meaning like, if the boiler is about to break, that sort of thing, or if the roof is shot. But they're not going to say, oh, there's a little tiny stain on the carpet over here, that sort of thing. So it just kind of shows that you're more serious. Otherwise, some people waive all that stuff. I don't recommend it. This is a very large investment that you're making. You need to have as much information on the property as you possibly can. If they pick someone else who chooses to waive it, then, good for them. But, I don't recommend that to my buyers.
Okay. So next question, kind of in along with expenses, is what do you think is going to happen with property taxes in the next couple of years? Because I'm not sure how they are valued or where they come from, but I'm assuming it's got to be tied to the value of the property, right?
Yeah. I've definitely seen property taxes on this most recent go around of assessments. So it gets reassessed every 2 years. They've definitely jumped up a lot, and it's tied to what they're selling for and all that good stuff. So I imagine that will be the trend over the next couple of years to, kind of catch up to rising prices.
Yeah, that makes sense. I mean, prices going up, taxes go up, same rate about. So for putting in an offer, how fast should an offer go in once a property hits the MLS? And then is it like so fast that you should think about doing it without actually seeing the property?
Yeah. So most multifamilies, if they're fully occupied, they do not allow for showings prior to an accepted contract. So I would say as fast as you can underwrite your initial due diligence, like you don't want to jump on it without, thinking it through, but just really kind of saying like, yep, this is the area I was looking in. This is kind of general ballpark. Yeah, let's jump on it because there's going to be like 10 other people that are doing the same thing. We can write in our contract a separate viewing period, but it's still, contractually, it's still within your inspection period. So as long as you have an inspection period within your contract, you can go in, eyes on the property, and then, kind of go from there, do your visual inspection. So yeah, I would say you do not get a chance to see the home and best that they can offer is, driving around the neighborhood and looking at it from your car.
Yeah.
Which is wild, but that's just kind of how it is.
Yeah. And that's, so I don't necessarily see that as a bad thing. So it's for a house hack, and I'm married. So for me, like, I care much less about, what the house looks like, how the landscaping is, like if it's homey, because it's going to be temporary. But the person I have to convince the most is my wife. Whereas if we can't even look at it, like as long as the area is good, it'll probably be good. It might help us out. So I think those are the biggest questions I had.
Yeah, those are all really fantastic questions. I'm super glad that you asked all of them because I think that those are a lot of very similar questions that people who are interested in multifamily would have.
Yeah, that definitely helps. So I feel a lot better now actually do an analysis. I feel like I'll get actually closer to what they'll be and not just shoot in the dark so much.
Yeah. And that's what we're here for. So, don't be shy if sending myself or Leah an email. Hey, what do you think rents would go for in this area? Or, what do you know anything about utilities on this building? That sort of thing. We're more than happy to answer it for you.
So I do have another one. What's the supply like of multifamilies in the winter? So like January, February. So the first time I looked into it was this past year, but this year was a unique year. What generally is it like?
So with investment properties, I would say it's not as cyclical as the standard real estate market cycle is for seasonality, just because, investors aren't tied to, if you're not living there, you don't really care when school starts and stops, that sort of thing, because it doesn't impact you. So I would say that generally speaking, it shouldn't be impacted by seasonality, but it's been such a weird year. I have no idea what to expect.
One, looping back around, I had a thought pop in mind, and geez, now it just left my brain. Well, going back to just kind of like, the balance of doing due diligence, putting offers in. I always think it's worthwhile if you can walk the property. It's always ideal too, because sellers can a lot of times tell. But the other thing too is there's a balance about how much due diligence work to do up front versus how much to do after you get under contract, with how fast the market moves and how friendly the contract, how buyer friendly the contract is out here in Colorado. We're very big proponents of like kind of if it passes a sniff test, like, hey, it looks good, numbers look good, put the offer in, get in a contract, then really do like a deep due diligence dive then, because at that point you get lending numbers, you'll get title reports, you'll get seller's property disclosures, we can get better rent comps, we can get the inspection reports, get much better scope, and then go re-underwrite the properties. And hey, if it still makes sense and works for you, and there's no major, inspection items or financing issues or insurance issues, great, move forward. If there is, you terminate, you'll be out a few bucks from just, your due diligence cost, but we're talking, $500, $800. So pretty insignificant. So it's balancing out like, hey, look at properties, but I would not put the stress on you, on trying to do like a full, underwriting, just because that's how fast the market moves. Is, get good at like, hey, here's the rules of thumbs. Hey, looks interesting to me. Let's go with it, and then do a deeper dive once it's under contract.
Mm-hmm. Okay, yeah, and that makes sense. So, how different are the inspections for a small multifamily versus a single family home?
They're not too much different. It depends on how I would say the biggest difference is how the heating situation is set up. If it's, one boiler or 4 furnaces, that would take them a little bit longer to kind of really analyze what the system that's going on down there. But otherwise, I mean, it's just a really, really large house. To simplify it, it's just one big roof, one big crawl space, that sort of thing. So yeah, it just takes longer just due to the size. But in terms of like intricacies, I haven't really noticed too much.
All right, that's good. Makes it a little easier. And then how long normally is the due diligence, like between offer and closing?
Yeah, so we would negotiate that in the contract, but generally speaking, due diligence is the first week and a half. Inspection would be on the later end. And by due diligence, I mean due diligence documents. So rent rolls, utility verification, leases, lease review period, that sort of thing, the paperwork aspect to it. And then you would be able to tack on inspection at the end of that period. And then, as those are the 2 big initial events that you'll have. And then there'll be small ones in between, like Chris said, insurance, estoppel statement sometimes, that sort of thing. And then towards the end, that's going to be more on the financing piece. That's where appraisal is going to come in. That's where you're going to get your final loan numbers. So it's constant work the whole time that we're under contract, but it's kind of like little mini finish lines for each one. And you're most likely going to fall out for either due diligence documents or inspection would be my, kind of blanket statement on that.
Yep.
You're saying like a week for inspection? That seems super fast.
No, that would be on the back end. So I would say a week and a half for due diligence documents. And then usually going into that second week, that's when you have inspection. Our team, we like to get inspection scheduled as soon as possible so that you have more time between, when you've had your inspection and then inspection objection or termination to get other trades in there. So for instance, say your inspector gets, out there 3 days once you've gone under contract and you have a week until your inspection objection. Well, you can get other trades in there, check out the roof if they called that out, or the heating elements, that sort of thing. You can get a more educated viewpoint on the whole picture, and then you have a better basis to make your decision off of.
Okay.
So great questions, Greg. We're coming up on the hour, so we'll need to wrap up here in a couple. Any final questions that you want to throw our way?
No, you hit every single one I had, and then even some new ones that came up. So thank you very much.
Oh, you're welcome. This was fantastic. Like, you asked great questions, so we appreciate it. You're prepared, and hopefully kind of gives you more guidance into the market. And of course, you have more questions, reach out to us, and we'll be happy to answer them. So Greg, I did not ask you this before the show, but a lot of times, the podcast is great for networking. Do you want to share any like ways people can contact your network, or are you rather just staying private?
Yeah, no, and that actually brings up another question. Investor associations or meetups. Like, are there any in the Springs that you guys recommend?
That's all you, Jenny.
So I moved down here when the pandemic hit. So I had been going out to meetups in Denver for real estate, just, because that's where I was living at the time. So, I have not been to any local meetups down here, admittedly.
Okay. Okay.
I mean, in my experience, I haven't been to Colorado Springs, but just going to different, RIA meetups, here in Denver, other parts of the country, I find them to be very hit or miss. And that can be the whole group itself, or just some meetings are very flat. So it's one of the things it's worth checking out there. But I think the more important thing, if you want to go there to the meetup, I would take the focus of anyone you go to, be proactive. And this is the best way you'll meet to meet people locally here and get to know some people is hey, go before the meetup, reach out, volunteer to set up chairs, or volunteer to help with the registration table, or whatever they need. Hey, a runner for the mic, like just whatever it is. But I've always had very good luck with that. I was actually talking with some people about this last night as well. Just they've done it in their completely different business, but same concept is, hey, go to them and meet up. And it might be a great meetup, might be a poor meetup, but that connection out there with the organizer, or just kind of getting your name out there, that often sets you up for success. And I think that's way more important, that type of networking, volunteering networking, way more important than you just going there and consuming information. Like, you'll get way more out of it if you're going there, networking in mind. And I found the best way to network is just go volunteer and set up some chairs, do the registration table, get the coffee brewed, whatever it is. Like, I've done that numerous times. I did that when I moved out here to Denver years ago. I've done other businesses, and it's been a very, very great model for me. So yeah, meetups, worthwhile, but man, volunteer and really use that to network.
Okay. Yeah, it's a good tip.
Yeah.
But going back to your question, Chris, email is the easiest way to get a hold of me.
Okay.
Especially in Germany.
Yeah. So we'll just share that in the show notes. So people that, want to connect with you, pick your brain, maybe they have an off-market fourplex, want to say whatever it is, reach out. Like, this is one of the great benefits of the podcast as well. Kind of going back to what we talked about in the RIAs, it's just a great way to network. So always like having people reach out that way, connect, and get a deal done. So Greg, thank you so much for coming on here and sharing your questions in public format. We appreciate it. Jenny, great job. And we'll keep everyone up to date on your fourplex house hack hunt.
Okay. Yeah. Thanks so much for all the help.
You bet. All right, everyone. Thanks for tuning in. If you guys have questions, reach out to me, reach out to Jenny. If you guys want to be on a future Ask the Investor podcast, reach out to us as well. The format's awesome. Great way to do some Q&A. So let's talk. Everyone have a great day.